Good morning, good afternoon, and good evening. Today we will talk about the last part of Chapter 12. We are almost there. Cheer! Hot tips: Inflation Index Bonds. We know that unanticipated inflation is devastating to bondholders. Inflation tends to increase interest rates, and as they go up, bond prices fall. And there's more bad news. Inflation also reduces the real value of a bond's interest and principal payments. Now a lead shield is available to investors in the form of Treasury Inflation Protection Securities, TIPS. These securities are immune to the erosion of inflation if held to maturity, and guarantee investors that their portfolios will retain their purchasing power. Long-term TIPS paid a basic interest rate of about 1% in 2014. But in contrast to old-fashioned treasuries, the interest payment is based on a principal amount that rises with the Consumer Price Index (CPI). If the price level were to rise 3% next year, the $1,000 face value of the bond would increase to $1,030 and the semi-annual interest payment would increase as well. When the TIPS mature, the investor gets a principal payment equal to the inflation-adjusted face value at that time. Thus, TIPS provide a guaranteed real rate of return and a repayment of principal in an amount that preserves its real purchasing power. No other financial instrument available today offers investors as reliable an inflation hedge. TIPS also are great portfolio diversifiers. When inflation accelerates, TIPS will offer higher nominal returns, whereas stock and bond prices are likely to fall. Thus, TIPS have low correlations with other assets and are uniquely effective diversifiers. They provide an effective insurance policy for the white-knuckle crowd. TIPS do have a nasty tax feature, however, that limits their usefulness. Taxes on TIPS returns are due on both the coupon payment and the increase in principal amount reflecting inflation. The problem is that the Treasury does not pay out the increase in principal until maturity. If inflation were high enough, the small coupon payments might be insufficient to pay the taxes and the imbalance would worsen at higher rates of inflation. Thus, TIPS are far from ideal for taxable investors and are best used only in tax-advantaged retirement plans. Moreover, the interest rates on TIPS during 2014 were considerably lower than their historical averages. Should you be a bond market junkie? Is the bond market immune to the maxim that investment risk and reward are related? Not at all. During most periods, so-called junk bonds, lower credit quality, higher-yielding bonds, have given investors a net rate of return 2 percentage points higher than the rate that could be earned on investment-grade bonds with high-quality credit ratings. In 2014, investment-grade bonds yielded about 4.5%, whereas junk bonds often yielded 5 to 6%. Thus, even if 1% of the lower-grade bonds defaulted on their interest and principal payments and produced a total loss, a diversified portfolio of low-quality bonds would still produce net returns comparable to those available from a high-quality bond portfolio. Many investment advisors have therefore recommended well-diversified portfolios of high-yield bonds as sensible investments. There is, however, another school of thought that advises investors to just say no to junk bonds. Most junk bonds have been issued as a result of a massive wave of corporate mergers, acquisitions, and leveraged, mainly debt-financed buyouts. The junk bond naysayers point out that lower credit bonds are most likely to be serviced in full only during good times in the economy. But watch out if the economy falters. So what's a thoughtful investor to do? The answer depends in part on how well you sleep at night when you assume substantial investment risk. High-yield or junk bond portfolios are not for insomniacs. Even with diversification, there is substantial risk in these investments. Moreover, they are not for investors who depend solely on interest payments as their major source of income. And they are certainly not for any investors who do not adequately diversify their holdings. However, at least historically, the gross yield premium from junk bonds has more than compensated for actual default experience. Foreign bonds. There are many foreign countries whose bond yields are higher than those in the United States. This is particularly true in some emerging markets. Conventional wisdom has usually recommended against bonds from emerging markets, citing their high risk and poor quality. But many emerging economies have lower debt-to-GDP ratios and better government fiscal balances than are found in the developed world. The emerging economies are also growing faster. Hence, a diversified portfolio of higher-yielding foreign bonds, including those from emerging markets, can be a useful part of a fixed-income portfolio in a period of very low interest rates. Exercise 7A. Use bond substitutes for part of the aggregate bond portfolio during eras of financial repression. Extremely low interest rates present a daunting challenge for bond investors. All the developed countries of the world are burdened with excessive amounts of debt. Like that of the United States, governments around the world are having an extraordinarily difficult time reining in entitlement programs in the face of aging populations. The easier path for the US and other governments is to keep interest rates artificially low as the real burden of the debt is reduced and the debt is restructured on the backs of the bondholders. We have seen this movie before. At the end of World War II, the United States deliberately kept interest rates at very low levels to help service the debt that had accumulated during the war. By doing so, the United States reduced its debt-to-GDP ratio from 122% in 1946 to 33% in 1980. But it was achieved at the expense of bondholders. This is what is meant by the term financial repression. One technique to deal with the problem is to use an equity dividend substitution strategy for some portion of what in normal times would have been a bond portfolio. Portfolios of relatively stable dividend growth stocks have yields much higher than the bonds of the same companies and allowed the possibility of growth in the future. An example of the sort of company in such a portfolio is AT&T. AT&T's 15-year bonds yield about 4.25%. Its common stock has a dividend yield of 5.25%, and the dividend has been growing over time. Retired people who live off dividends and interest will be growing over time. Retired people who live off dividends and interest will be better rewarded with AT&T stock than with its bonds. And portfolios of dividend growth stocks may be no more volatile than an equivalent portfolio of bonds of the same companies. In the specific recommendations that follow, I recommend such a partial substitution of stocks for bonds in that part of the portfolio designed for lower risk and more stability. During periods of financial repression, the standard recommendations regarding bonds need to be fine-tuned. Exercise 8. Tiptoe through the fields of gold, collectibles, and other investments. In previous editions of this book, I took different positions on whether gold belongs in a well-diversified portfolio. At the start of the 1980s, as gold had risen in price past $800 an ounce, I took a quite negative view of gold. 20 years later, at the start of the new millennium, with gold selling in the $200s, I became more positive. Today, with gold selling at about $1,300 an ounce, I find it hard to be enthusiastic. But there could be a modest role for gold in your portfolio. Copyright George Price, The New Yorker Collection, www.cartoonbank.com. All rights reserved. Another popular instrument these days is the commodities futures contract. You can buy not only gold but also contracts for the delivery of a variety of commodities, from grains to metals as well as foreign exchange. It's a fast market where professionals can benefit greatly, but individuals who don't know what they are doing can easily get clobbered. My advice to the non-professional investor: don't go against the grain. I would also steer clear of hedge fund and private equity and venture capital funds. These can be great moneymakers for the fund managers who pocket large management fees and 20% of the profits, but individual investors are unlikely to benefit. The average performance of these funds is deeply disappointing. True, the best funds have done quite well, but unless you are an institutional investor who has established a clearly preferential position, your chance of investing with the best is realistically zero. Ignore these exotics, they are not for you. Exercise 9. Remember that investment costs are not random, some are lower than others. Many brokers today will execute your stock orders at substantial discounts off standard commission rates. The discount broker usually provides a plain paper service. If you want your hand held, if you want general portfolio advice and investment suggestions, the discount broker may not be for you. If, however, you know exactly what you want to buy, the discount broker can get it for you at much lower commission rates than the standard full-service house, especially if you are willing to trade online. Trading stocks online is easy and cheap. But let me warn you, few investors who try to trade in and out of stocks each day make profits. Don't let low commission rates seduce you into becoming one of the legion of unsuccessful former day traders. While we are on the subject of commission costs, you should be aware of a Wall Street innovation called the wrap account. For a single fee, your broker obtains the services of a professional money manager, who then selects for you a portfolio of stocks, bonds, and perhaps real estate. Brokerage commissions and advisory fees are wrapped into the overall fee. The costs involved in wrap accounts are extremely high. Annual fees can be up to 3% per year, and there may be additional execution fees and fund expenses if the manager uses mutual funds or REITs. With those kinds of expenses, it will be virtually impossible for you to beat the market. My advice here is, avoid taking the wrap. Remember also that costs matter when buying mutual funds or ETFs. There is a strong tendency for those funds that charge the lowest fees to the investor to produce the best net returns. The fund industry is one where you actually get what you don't pay for. Of course, the quintessential low-cost funds are index funds, which tend to be very tax-efficient as well. There is much about investing you cannot control. You can't do anything about the ups and downs of the stock and bond markets. But you can control your investment costs. And you can organize your investments to minimize taxes. Controlling the things you can control should play a central role in developing a sensible investment strategy. Exercise 10. Avoid sinkholes and stumbling blocks. Diversify your investment steps. In these warm-up exercises, we have discussed a number of investment instruments. The most important part of our walk down Wall Street will take us to the corner of Broad Street to a consideration of sensible investment strategies with respect to common stocks. A guide to this part of our walk is contained in the final 3 chapters, because I believe common stocks should form the cornerstone of most portfolios. Nevertheless, in our final warm-up exercise, we recall the important lesson of modern portfolio theory: the advantages of diversification. A biblical proverb states that, "In the multitude of counselors there is safety." The same can be said of investments. Diversification reduces risk and makes it far more likely that you will achieve the kind of good average long-run return that meets your investment objective. Therefore, within each investment category you should hold a variety of individual issues, and although common stocks should be a major part of your portfolio, they should not be the sole investment instrument. Just remember the teary-eyed ex-Enron employees who held nothing but Enron stock in their retirement plans. When Enron went under, they lost not only their jobs but all their retirement savings as well. Whatever the investment objectives, the investor who is wise diversifies. Recall also the sinkholes and stumbling blocks covered in the section of Chapter 10 entitled, "What are the lessons for investors from behavioral finance?" We are all too often our own worst enemy when it comes to investing. An understanding of how vulnerable we are to our own psychology can help us avoid the common pitfalls that can make us stumble on our walk down Wall Street. A final checkup. Now that you have completed your warm-up exercises, let's take a moment for a final checkup. The theories of valuation worked out by economists and the performance recorded by the professionals lead to a single conclusion: there is no sure and easy road to riches. High returns can be achieved only through higher risk-taking, and perhaps through acceptance of lesser degrees of liquidity. The amount of risk you can tolerate is partly determined by your sleeping point. The next chapter discusses the risks and rewards of stock and bond investing and will help you determine the kinds of returns you should expect from different financial instruments. But the risk you can assume is also significantly influenced by your age and by the sources and dependability of your non-investment income. Chapter 14 – A Life Cycle Guide to Investing will give you a clearer notion of how to decide what portion of your capital should be placed in common stocks, bonds, real estate, and short-term investments. The final chapter presents specific stock market strategies that will enable amateur investors to achieve results as good as or better than those of the most sophisticated professionals.